Thank you for the intro and welcome everyone to our program today. What's it worth valuing a business for sale? We have here with us several individuals that are highly experienced in valuation and related issues. And we also have an individual that's highly experienced regarding legal advice in planning and selling a planning a business sale and actually executing the sale of a business from a legal perspective. So before we get into our program, a few housekeeping items. First, Financial Poise is our underwriter for these programs and has an entire series available at financialpoise.com. We encourage you to check that out. Our sponsors today include the National Law Review, a premier legal news website. Also includes Max Asset, a restructuring and insolvency professionals firm. A brief disclaimer, we're here to have a lively discussion, offer current insights and general information, but it's not legal, financial, or other professional advice regarding any particular matter. You should engage professionals directly for that purpose. Nevertheless, any of us would be glad to hear from you if you have specific questions. And so that's a good introduction to giving me an opportunity to say a little bit about our faculty. Megan Beckwire, Richard Claywell, Catherine Puffer, and Tom Walsh are joining me today for our discussion. I'm the moderator. Megan is the principal and founder of Dispute Economics. She has over 20 years of experience on valuation and investigation consulting matters. Richard Claywell is the founder and principal of Richard Claywell CPAs. In addition to being a CPA, he has several additional certifications and credentials in valuation, financial analysis, and forensic accounting. He's also very experienced. And also we have Catherine Puffer. Catherine is with the firm of VH Valuation. She's one of the principals. She has several years and decades of experience as well. She's a CPA here in Illinois. I should mention that Megan is based in Philadelphia. Richard is based in Houston. Catherine is based here in Chicago. Catherine, in addition to doing valuation disputes, also does valuation for transaction purposes. I should also mention Richard also does quality of earnings analysis for transaction purposes. And then Tom Walsh is joining us. Tom is from Connecticut. Tom is with the firm of Brody Wilkinson. He's a principal there, and he's a member of the business and real estate group. He's highly experienced in sales and acquisition transactions of companies. And me, I'm with the consulting firm of HKA Global. I do regularly quite a bit of business valuation and forensic accounting work, both in the litigation arena and outside the litigation arena. So today we're going to talk about what's it worth valuing a business for sale. So before going to market, we'll talk about questions that you as the owner or you as the advisor or legal counsel or the accountant or other type of consultant to the business may have. And we'll talk with our panel. We are talking in the first of the series on valuation. So in addition to today's program, you can find on the on the financialpoise.com website, the schedule and opportunities to register to attend additional programs in our series. Before I jump into turning it over to our panel, I wanted to mention that we have these slide materials that we've assembled for our audience to review. Please feel free to leaf through these at your convenience. They're available for download if you haven't already, and they include quite a bit of information. Feel free to take notes, print these, use these as you please. During today's program, we'll have a lively discussion. We'll touch on many of the points that are built out a little more in the slide deck for your own use. We won't leaf through the slides specifically because we want to really hear from our panel and give everyone in the program today an opportunity to hear their insights. So with that, we're going to go through a series of questions. And the way that we'll proceed is I will pose a specific question to one of our panel members. They'll provide some feedback and insights. And then from time to time, some of the other panel members may choose to ask, not to ask, but choose to add some additional comments. So with that, why don't we start with Catherine and Tom? Uh, when should a business owner think about getting a valuation?
Yeah.
Catherine?
Yeah. Thanks, John. I really appreciate it. There's just a whole lot of reasons um, for a business owner to get a valuation when they're considering selling their business. I'll just talk first about when the sale is imminent. So one of the reasons that you'd want to get a sale of your business when you're really kind of in the midst of it is you want to be realistic about what the value of your business is. And you come at that from two different perspectives. The first is if you price too high, it could take a really long time to sell the business, or you may not be able to sell it at all. If you price it too low, you won't be getting value for your business. So really understanding what your business is worth is important, and getting an appraisal would be very helpful. So the second reason is if you know your prospective buyer, and a lot of times, a lot of the sales or the transactions that I get involved with, the seller does know the prospective buyer. If that's the case, the business appraiser can provide the seller with an estimate of what the buyer the business might be worth to the buyer, and that's different than your run-of-the-mill business appraiser that's done for litigation, which is just business as usual. So, and we'll talk more about that later, but that buyer might have some real specific reasons for wanting to buy the business, and it could be worth a lot to them. So that's another reason. It also can be extremely helpful when negotiating a sale. So if you have an appraisal and both the buyer and the seller view the appraisal as neutral and objective, it really can go a long way to helping the two parties come together on a sale price. The other thing is, because I do a lot of litigation, I do a lot of shareholder disputes, you can use a business appraisal to buy out minority shareholders and avoid a shareholder dispute, or at least help to avoid a shareholder dispute, which could be very good for the business. Also, if your buyer is a family member or a long-term, very valued employee, it can be used to justify the sale to the IRS. So the IRS doesn't come in and say, oh, this is compensation, and charge the employee compensation because they say the sale price is too low, or say, hey, you gifted this to your kids or to your family member, and treat it as a gift rather than just a bona fide arm's length sale. So those are some of the reasons that I can think of that it's important to get a business appraisal when you're contemplating a sale. But I do want to encourage any business owners out there to get an appraisal 3 to 5 years before, so that you can start to work on improving your business so that you can get a better sale price when you do sell it. And just a couple of things that are important there is eliminating discretionary expenses, those expenses that aren't absolutely vital to the operation, or just simple things like collecting receivables faster, or managing inventory better. That actually improves the value of the business. There's a lot of other things, and I won't go into it in detail, but I think it's really helpful for somebody that thinks they're going to sell their business in a couple of years to get an appraisal now, and then look at the appraisal to determine what levers they can pull to improve the value of their business. So, Tom, you probably have some things from a legal perspective to add to that?
You covered a lot of good ground here, Catherine. I think the only few things I would add is that I sometimes see clients getting ready to sell their business want what they call, a back of the envelope valuation, for lack of a better description. So sometimes, for cost reasons or other reasons, sometimes business owners don't want a full-blown valuation, with a 200-page report that might accompany, a real full-blown valuation. But they do want to have a good idea of what the market value might be. And especially this is more relevant if somebody's going to go out to auction their business. So they might think that, I'll let the market decide how much my business is worth. But I really would like a feel for it going in. I really like the point you made about getting one done a few years ahead of time. Because I think that is, and I'll talk about this a little bit more. But that's, preparing for the sale and improving things the year or two before you're getting ready to sell is, just critical. So I think that's a really good point.
Let me tell you something that you all are both right on point. A number of years ago, I met with a prospective client to value the company because he thought he had two companies. He wanted to sell them. We talked about all the goodies that go along with that, and he decided he did not want us to do evaluation. He didn't want to pay our fee, and that's fine. Didn't hear from the guy for about 3 or 4 years, and then he called me. He was at a closing table trying to sell his company, and now he's asking me, what's a good value for me to sell this thing for? So all the things we're going to be talking about today, he did not do any of it, and he's going completely in the blind. I couldn't help him. I don't think anybody on this panel could really help him because he did absolutely zero planning. This is a planning process. So like Catherine and Tom said, don't wait. Don't put this off. You've got to start today if you haven't already gotten started to get this accomplished.
Well, thank you. Tom, what about succession planning? Is there a role for considering succession planning? And if so, is there a major mistake that sometimes business owners make when they're trying to sell the business that perhaps they could avoid?
Yeah, yes. I think of succession planning being, there's a family member, and is there a logical, replacement within the family to take over the business? And that is, it's almost its own area of work. But certainly in that situation where there was a family member who's going to buy, what Catherine was talking about before, getting some sort of outside, valuation as sort of the, the honest broker as to the value, that would be critical. But in terms of, mistakes people make, I think what I see sometimes, and Richard was just alluding to this, is just a lack of preparation. Whether it's somebody who gets a surprise offer and they just decide to run with it, or somebody who just has not taken the time, they're too busy, or they're very concerned about costs, who just take, or they think they can do it all on their own. That's part of the nature of entrepreneurs. Somebody who doesn't take the time ahead of time to prepare. So that can be not having the right team in place, not having the proper attorney to handle their transaction and help negotiate it, having an M&A advisor to help them negotiate the sale, being ready, being ready to put their best foot forward. Again, what Catherine was talking about, are you entering into a sale, having some good, financial years behind you? And then are you ready to do what you need to do to close? Do you have the right personnel in place to carry you forward during that, 9 months to a year where you're juggling, selling the company with keeping your numbers up? Because you can bet the buyer is watching your numbers, and if you don't meet budget, you're going to pay the price on a retrade where the buyer says, okay, your numbers are down 10%. If you're lucky, they might say, well, that I'm gonna insist on a 20%, reduction in the sale price. Or it could be worse. You could lose a deal because you haven't been able to keep things up. So getting ready, being ready, is critical. I can talk also a little bit about, you know, having a letter of intent, proper letter of intent in place, a proper non-disclosure agreement in place. But maybe I'll let somebody else jump in if they want to. Otherwise, I can talk a little bit about those things as well. If, but maybe I'll just mention briefly, John, this idea of having the letter of intent in place. I sometimes see, in terms of mistakes, this is probably, if not being prepared is the overall mistake, then this is the biggest specific mistake, is somebody signing a letter of intent before they share it with their advisors. That's the opportunity to really nail down the deal terms. The seller has a lot of leverage at that point, because the buyer's obviously anxious to get a deal done. And so I cringe every time a client comes to me and says they're ready to sell their business and they've already signed the letter of intent, because that's an opportunity for, that's an area where a good M&A lawyer can add a lot of value and make a lot of money for the business owner, just by taking a few extra hours, few extra days, and getting it put in the right spot.
Well, thank you. Richard, we heard from Catherine and Tom earlier about there may be different reasons and purposes to get a business valuation. So the related question we have for you is selling price or fair market value? Is the price at which a company sells always the same as fair market value, or sometimes can there be differences?
Well, I would say probably 100% of the time there are differences. What winds up happening is we have standards of value, and these are methodologies and techniques that are generally recognized within the valuation community. So everybody should be doing the pretty much the same thing. If Catherine and I are working on a case together in opposition, one for the buyer, one for the seller, our numbers should be pretty darn close, because we're using standardized techniques to get from point A to point B. That's the whole principle of this thing. This is based upon a hypothetical buyer and seller transaction. So we're going to use, and the term is called fair market value, to get to that number. And again, and Catherine, I'm going to pick on you for just a little bit here because you spoke first, that we should be very, very close to the same answer. Now, the selling price is not a hypothetical buyer and seller, it's an actual buyer and seller. So I don't want to really pay for this, or I think you've overpriced something here or there. So now let's jockey the price around a little bit to get from point A to point B. Well, and Tom mentioned a while ago, the letter of intent, that there could be some things in there that he could have done that would have made it a lot better for the client, but the client didn't do that. So that will impact the value based upon the actual transaction and not necessarily a fair market value standard for the value. So there's numerous factors that go into this. Those answers are probably not going to be the same. If you're going to sell your company or you're going to buy a company, and I believe it was Tom that said you need to have the right professionals in place. We recognize those types of things and we can throw those issues out, then you can negotiate those. And that's going to get you to your selling price versus the fair market value price.
Well, thank you. Megan, a related point on price. Buyers and sellers, we heard from Richard about a hypothetical standard, but in actual transactions, do the motivations of a particular buyer or a particular seller make a difference?
Oh yeah, absolutely. Because, it ultimately comes down to the amount of cash that the buyer believes they can put in their pocket operating that business. So there can be any number of scenarios that would cause that particular buyer to be able to increase profitability, for example. Maybe they're a competitor and they're going to roll this acquisition into their existing operations. So there's going to be some cost savings that can be achieved. Or maybe they just want to take the competitor out because, you know, they believe they have a stronger business plan and they want to monopolize the market in that area, or, you know, something similar. They could be motivated and they could pay a premium because of that, because it will have more value to them than it would a hypothetical buyer.
So we heard from Richard about fair market value. So Megan, the motivations, what's fair market value assume in the hypothetical about motivations?
Well, it doesn't assume that there's going to be any strategic value or synergistic value that would be inherent in what I'm talking about, which is investment value. It's value to a particular buyer.
Okay. All right. Well, thank you. Tom, you touched on sometimes it's a family-owned business and maybe the natural successor is another family member. So are there some other differences in the dynamic when it's a potential sale of a family-owned business?
Yes, there are, you know, and I run into a lot, somebody who for whatever reason has decided, you know, there's not a suitable family member in the business to take over. So they decide they're going to exit the business. You know, that has a value in itself in that it, especially if there's, you know, multiple kids and kids inside and outside the business, you know, there's a pool of cash that the seller will realize out of the sale, and then can, you know, share that within the family as they wish. But when I get that call, you know, a family business owner, you know, I ask specifically about that, because oftentimes business owners have in mind, you know, they're going to sell, somebody in the family is going to take over. So when I get the call that that's not going to happen, try to find out a little bit about why, you know, why that is. It can be an emotional letdown, you know, when the nobody in the family is going to be taking it over. But then I tell them, you know, teach them about or talk to them about what it's going to be like selling to a third party, you know, that it's going to be, you know, the typical process I talked to about earlier. It'll be months of juggling two hats, you know, running the business and then working on the sale of the business. And so all the management team is going to be having to do double duty. But, you know, where there's oftentimes several family members in the business, even though one of them might not be ready to take it over. And there can be, you know, family and business interests that intersect. So you might have somebody who works in the HR department at the company and is not very good at their job, but they do a great job of taking care of mom. And so there'll be a lot of concern, you know, as to how that person's going to fare with the new company. Are they going to be able to handle the rigor of working at a private equity backed firm? Can they, you know, will they be able to have the freedom that they currently have? You know, the going to Vermont every Friday during the winter to go skiing, is that going to be a possibility at the new place? So there's a lot of, you know, it ends up being not the usual financially rigorous analysis you might see with a professional, you know, seller. And there's some of these other things come into place. Is there a family member who, a patriarch of the family, or matriarch who maybe doesn't own the company anymore, but still has a lot of influence. Maybe mom and dad transferred ownership to the next generation and aren't owners, but they still have a tremendous amount of influence. So when you're, as a lawyer, part of what I'm doing is figuring out how this all fits together. How do we make sure we get everybody lined up and going in the right direction? Make sure that people's, understandings are, appropriate. And then, so dealing with all that before you work, head into the documentation stage. People might be used to operating behind the corporate veil of the company where they don't have personal liability unless they sign a personal guarantee of a bank loan or a lease. And here they're going to be, when they're selling the business, they're going to be asked to make a lot of these personal representations and warranties about the business, and are going to have to live with them for a period of time after the closing, so that if something turns out to be not accurate, they'll have to, take care of it either monetarily or making good on something that's gone wrong.
Well, thank you. Catherine, a couple of our other panel members touched on the word synergies, and one of the most famous, we heard the word professional sellers, I suppose professional investors over the last 60 years is Warren Buffett. And Warren Buffett essentially said that he does not like to pay for synergies. So would you share some insight with our audience? What are synergies, and will a buyer pay for them?
Well, I think that the market indicates that the buyers do pay for synergies. I think some of the more noteworthy purchases are tech companies buying other small tech companies that aren't making any money for way over, except that they're not making money. They're not really worth anything all by themselves, but they can take their technology and they can take the expertise of their employees and really leverage them into something that is very, very valuable. So I think that they do pay for synergies. Perhaps Mr. Buffett is just talking about how he buys companies, and he's done pretty well, so I can't argue with that. But let me talk a little bit more about synergies. Most buyers are buying companies, or a lot of them are, because they intend to make changes to the company to increase value. And that might be some expense savings and that type of thing, or revenue increases because maybe they're buying a distribution system and they have access to a different market, or they can cross-sell to existing customers and that kind of thing. Also, but I think that a lot of big synergies come from, like I said, the intangible property. It might be code, it might be a patent, it might be a trademark, etc., and employee expertise. And I just want to share one example of a sale that I was involved in, where a very, very large corporation bought a very, very small professional practice. This large corporation was involved in a lot of acquisitions, and they were rolling up, if you will. And the head of this small professional practice had a very, very large network and very good skills that would enable the company to enhance their acquisition efforts. So I think that to me was pretty interesting, because the two businesses weren't in the same industry at all. But in order to get this particular person, they had to buy this professional practice, and I viewed those as synergies. But there's more mundane synergies, just as eliminating a finance department or things like that. But I thought it was kind of an interesting aspect to the synergistic conversation. So that's it.
Well, thank you.
Yeah.
Richard, if I were to look at a professional business valuation appraisal report, would it be typical that I'd find something labeled as a standard of value? And if so, does the standard of value make a difference as to the resulting valuation opinion?
Should see in a report what I'm going to tell you what we did. And based upon what I tell you what we did, that indicates how we're going to do that. So for example, it would say the standard of value would be fair market value. And I'd mentioned previously that those are standards, recognized procedures. And I think Catherine mentioned normalizing entries. There's a lot of things that we're going to do to that to make it where it doesn't represent your historical operations. It's going to represent what we anticipate the future operations to be. And now we're looking for a cash flow number to figure out how much cash we're going to make. But it's going to be based upon stripping out items that we don't want to have in there. For example, here in the Houston area, we have what we call go fast boats. And you all may call them cigarette boats or whatever you want to call them. But these are these boats that are, probably 150, 200 feet long. And they've got, 6 jet engines on them. And you go out and go fishing with them. You don't really go fishing, but they're expensive boats. And a lot of these guys around here will take prospects out. You don't need a boat like that to run an engineering firm or an accounting firm or any other kind of firm, I don't think. So you'd want to remove those types of things to get to what our normal operations would be. And typically that's under fair market value. Now, what Catherine was talking about a while ago is synergies. These are items where I think I can get some money for these because I've developed whatever, and I want you to pay for that. So in our report, we would say synergistic value or strategic value. That puts me on notice right away that I've probably gone out and done a fair market value, but I've adjusted it for the synergies that are there. When that's done, I believe that those synergies should be able to be identified, and you could carve those out fairly easily to say, yep, this is the synergies that this person wants me to buy. And so just the terminology will put you on notice what it is. Then you need to have that trained eye to look at it to see what is the difference between the synergistic value and a fair market value, the number that may be out there. And there's if we're doing an investment value, it talks about that. What are we looking for and how would that differ from the language if we're going to use synergistic or fair market value? So those standards of value are key because that tells us what we're going to be doing and in theory, how we should be doing that so we know what to look for.
So the answer in the valuation opinion could be higher or lower depending on what the standard of value is. And also there may be some additional components or fewer components
Yeah,
depending on the standard of value.
Yeah, there could be additional or fewer components. Again, if we use fair market value, we're pretty much doing the same thing and we should be pretty close to where our answers are going to be the same. But now if I'm going to be looking at, and Catherine, I'm going to pick on you again, okay? If we use strategic value, something that I think might be a strategic value indicator, she may not think it's a strategic value indicator. So one of us is going to include it in our analysis and the other one is not going to include it in the analysis. And that's going to make the final result more different than what it would have been if we just would have used fair market value. But that's why it's key to know what it is that I'm doing so you know which standard I'm using and which standard the other expert is using so we can key in on what those differences are.
Well, thank you. Megan, another question about terminology in a professional business valuation appraisal report. There are sometimes some terms like invested capital, enterprise value, equity value. And so are those terms different things? What do they mean and how are they different? And then when a company is sold, are companies priced based upon one of or more than one of those measures?
Sure, John. Yeah, there's a difference between them and, probably the definition isn't exactly fully agreed upon amongst everybody because market value of invested capital is supposed to be all of the assets and the market value of those, to come down to the equity of the company plus the market value of the debt. And enterprise value is the operating value. So sometimes analysts will remove all of the cash. Now there's an argument to say that some of the cash is actually needed to generate the income that causes the business to have that value. So you have to kind of make sure that you're looking at the definition and understanding what the analyst has done. But the enterprise value should be all of the operating assets that allow for the future earnings to be generated that are expected. So market value of invested capital would include that the value of that boat that Richard was talking about, enterprise value would not. And typically you're going to see both of those laid out in the report because when you do your valuation methodologies, they're going to come up with an enterprise value typically. So any of those, non-operating assets that you've got on the books are going to have to be added separately to get back up to market value of invested capital. And then the equity is just the difference between those two things and what is the interest-bearing debt. So it's what portion the equity owners own of that company. And it depends on the valuation and the purpose of it, but I would say certainly non-operating assets are generally not going to be included in a transaction. And if it's a minority interest, then you're looking at typically only an equity valuation.
So does the answer in part turn on how the sale is structured? In other words, if it's a corporation, it's a sale of 100% of the capital stock, or if it's a corporation, it's a sale of substantially all the assets. Might that make a difference?
Yeah, definitely. I mean, certainly it wouldn't, the equity value wouldn't be applicable or really an important factor if you're purchasing certain assets of the corporation.
Okay, well, thank you. Catherine, if we go to a lot of the public websites and look up public stocks, one of the common statistics we'll see is price earnings ratios. But when it comes to transactions and analyzing companies more specifically, quite often there are other acronyms like EBITDA, or EBIT, and the like. Are those measures or metrics of earnings that are quite often looked at by those that are advising or thinking of buying or selling a business? Basically, EBITDA, what is it? And is that something common? And are there others that you see as well?
Yeah, a multiple of EBITDA is used by a lot of people to describe what the value of the business is. Usually those come from averages of sales in the industry, average transactions. And one of the things that I want to caution the participants in this webinar that those are what we call rules of thumb. They're averages. And what I find is that most small businesses are fairly unique. So I use those averages. I use similar sales as cross checks to my analysis of cash flow and risk. Because the analysis and estimate of value based on cash flow and risk is based on that particular company and all of its unique characteristics. So with that said, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And for the most part, it's a measure of what cash flow is being generated by the operation. And what I find in my practice anyway, the small privately held businesses that I value, that isn't generally the best way to estimate value based on similar sales. What seems to be more statistically reliable is either the revenue multiple or the discretionary earnings multiple. Revenue is pretty obvious, it's sales. But so it's a measure of what the company sells for in terms of as a relationship to sales. Discretionary earnings is pretty close to what EBITDA is, plus owners' compensation and benefits. And when I look at the multiples that are generated by similar sales, I find that those multiples are much closer together, much closer to each other than the multiple of EBITDA. So in many cases, I always look at how closely the multiples are grouped together, and I use the ones that are grouped together the most because that indicates that's the better way to estimate value. And I find in my valuations anyway, the seller's discretionary earnings usually comes out on top in terms of reliability. So it's operating income plus owner's benefits plus depreciation and amortization. But you know, it does vary by industry. So there's a lot of different multiples. And for example, book value can be used reliably in the banking industry, although I don't do a lot of banking work. But it is something that is unique or somewhat unique to that industry. So you really have to look at what you get in terms of multiples, in terms of similar sales, and then analyze them statistically to be sure that the multiple that you're using is reliable for your particular industry or your particular company.
Well, thank you.
Okay.
Richard, if an analyst thought that EBITDA or revenue, like Catherine was mentioned, might be some appropriate metrics to consider in evaluation, do they just take those numbers historically at face, or there's sometimes some pro forma or normalization adjustments?
Items that we call normalizing adjustments, and what this consists of, and I kind of mentioned it a while ago when I was speaking, what we want to do is to take those financial statements that the seller has and convert those into what I would call economic financial statements. Historically, I really don't care a whole lot about what you've done or how you've done it, but more than likely, and especially when you deal with smaller companies, owners live out of these things. They pay for the kids' cars, they pay for the vacation homes, they pay for the vacations, schools, the college education for their kids. All this stuff is mixed up with their business. And if I'm going to buy that business, I don't care about making a contribution to your church, to your United Way, to whatever it happens to be. So we want to pull that stuff out. So what I'm looking for is, what am I going to be generating in the future? So the process is called normalizing. Take a look at that and adjust for those items and get the trash or the garbage out of there. We also want to look at compensation. And to be perfectly honest with you, I really don't care how much money you pay yourself. I mean, to me, that makes no difference whatsoever. But when you're selling your company, what we want to look at is reasonable compensation. If you're taking out $500,000 a year on your relatively small business, and this thing just keeps on going, that's fine. But if I'm going to buy your business, I'm not going to pay somebody to replace you and pay them $500,000. So we need to look at what reasonable compensation is and adjust that reasonable compensation for that. Where I've come into issues with people in valuing businesses is a lot of times they will underpay themselves. And so we will come back in and we will add, let's say you're taking out $100,000 a year. And I look at the studies that are out there and determine that, well, you should be making $200,000 a year. So part of the theory is I'm going to get replacement management to come in and take your place. Or what would I need to pay somebody to do your job? So I'm going to add $100,000 to the expense, which is going to decrease the value. And that just makes the current owners go absolutely nuts. They just don't quite understand that. But that's what we're looking for, is what would it take to replace you and to make this an economic set of financial statements. So we want to do that. Once we know what that is, then we have a better idea of what the true EBITDA or cash flow would be for the company and how much money you're actually going to be generating off of this.
Well, thank you. Tom, what methods have you seen in valuing businesses that are offered for sale?
Yeah, I've seen all the ones that Catherine, Megan, and Richard have talked about. It doesn't seem like there's a one size fits all. So I've seen, the most typical one I see is the EBITDA model. I think a lot of the M&A advisors I work with, they are always in the back of their minds thinking about selling to a financial buyer or having the client sell to a financial buyer. And the private equity groups typically will look at want to look at EBITDA and then, offer a multiple of that to determine the purchase price. And the multiple, it can be all over the place depending on the industry. But I've seen, and I've seen what Richard was talking about, these adjustments that get made. So it's one of the things we talk to clients about is getting your books together so it looks most attractive. So if you're taking out, you're paying all these charitable donations out of the business, or your family members who don't really work there are on the payroll, or everybody's got a runs their vacations and gas cards and vehicles through the business, get those normalized. Sometimes it can be book value, could be book value plus goodwill in certain circumstances. I've seen what Catherine was talking about the earnings, calculation. So it's all over the place. It seems to me, based on just what I've seen, it's, and what I've been told, it can be an art, as much as anything. It's not just not all science.
Well, thank you.
Let me make a comment about that, because this happened 15, 20 years ago. We were valuing, it wasn't for sale. There was an estate tax. The owner of this construction company had died. The son was running it, and the mother worked in there also. My question was, what does your mother do for the company? Her sole purpose was to go to the post office in the morning and pick up the mail and bring it to the office. And she only got paid $78,000 a year to do that.
Right.
So if you're going to buy a company, how many people are you going to pay $78,000 to do what, a half-hour task, an hour task per day, something like that? So you got to look at this stuff. You can't just glaze over the numbers. You got to dig into it and see what's going on.
Yeah, and if I could just add one more thing, John, to what Richard was saying. A lot of times there's real estate involved in these businesses as well. So there's a component where there's a there's a related business that owns the properties on which the business is located. And maybe there's an artificially high rent that's being paid because that's considered to be a tax efficient way to get money out of the operating company. So that'd be the other thing I would mention is it's important, especially with these smaller businesses, to look not only at the business, but also the real estate part, and especially if you're going to be planning to sell that.
Well, thank you. Megan, is valuation forward-looking? And if so, how important is the forecast of future performance of the business? And then how do you develop that?
Yeah, the answer is absolutely. Valuation is based on what you expect to be able to achieve, take out of the business in cash in the future years that you're going to hold it, and then, reduce to present value based on the risk of achieving that. So the forecast is vital in establishing the value of the business. And a lot of times business owners will put together a forecast and it's up to the valuation analyst, or it would be, you know, up to a buyer as well and their team to really test it for reasonableness. Because a lot of times maybe it's an early stage company and you're looking at like a hockey stick projection, they like to call it, where it's been going down, but oh, we all believe it's going to turn around and go back up now next year. And there can just be some really aggressive assumptions in the development of a forecast. Sometimes the business owner for a small business really hasn't put together projections or forecasts at all, doesn't have any training in doing that. So another way to test the reasonableness is to look at prior year's budgets versus the actual that they were able to achieve, just to see how close they were able to come, you know. And sometimes you can actually use the seller's projection as a starting point, but most likely based on, you know, what is anticipated to happen in the industry and the valuation analyst's own research, there'll be either some modifications made to the budget or the projections, or there's going to be an increase in the discount rate because it will reflect a higher amount of risk of achieving those cash flows.
Well, thank you.
John,
Richard, another
what-
acronym sometimes we see is IRR in an appraisal report. What is that?
The IRR it's called an internal rate of return. And it depends on how you're trying to use that, whether it's, i.e. meaningful or not, in my opinion. The internal rate of return is used primarily for capital budgeting. We want to build a project, some equipment, a building, whatever it happens to be, and what sort of a return do we anticipate getting on our investment? That's what the internal rate of return deals with. When we value a company, what we're looking for is the present value of the future earnings of the company, whether it be EBITDA or cash flow. Those two are done differently. They're not the same animal. A lot of people, in my opinion, think that they are. I've had several discussions with attorneys about that and other experts, but it's also known as a hurdle rate. I would like to get X number of dollars out of this particular project, and can we do that? If we can do that, then you could use your IRR as a measurement for that.
Well, thank you. Catherine, sometimes in publicly reported transactions, we see something called contingent consideration. And in fact, on some public company financial reports, when they do their required filings, we'll see in the notes to the financial statements a disclosure about contingent consideration and maybe even some calculations. What is contingent consideration and why is it used?
Contingent consideration is also known as an earnout, and it's frequently used in business sales. Basically, the buyer agrees to pay the seller additional monies over a number of years if the business does well or certain guidelines are met. In transactions that I've been involved with, this has been used when the buyer wants the seller to stay around to ensure that customers stay around, that certain critical relationships are maintained and that type of thing. One of them that comes to mind is I was involved in the sale of a civil engineering firm to a much larger civil engineering firm, and the seller stayed around, and there was a lot of there was a big earnout there to ensure that all those relationships were transferred. It can also be used when the buyer and the seller don't agree on the outlook for the company. Maybe there's a hockey stick, as Megan mentioned, or something like that. They might deal with that particular outlook, difference in outlook in terms by using an earnout. So that's kind of what I have to add on that one. Does anybody else see anything in their reasons to use an earnout in the transactions they've been involved in?
I usually see it, as as you alluded to, is a bridge, between the parties. Somebody has in mind they need to get this number. The buyer is, skeptical or wants to protect its, downside risk. And so I see it in that circumstance as well, along with the retention one you were talking about, Catherine. So that's what I've seen that in that circumstance quite a bit.
Well, great. As we come to the last few minutes here, Tom, are there some tools to help reduce legal complexity and the sale of a small privately owned business?
Yeah, you're asking me to bid against myself here, John, but but I think,
Well, you may be one of those tools, Tom.
yeah, I think it's as I was saying earlier, I think the single document that could help save some time is that letter of intent, and to spend more time than you think on it. Get your lawyer involved. Um, you know, I recently worked on a transaction where we spent a few weeks on the letter of intent, and we were able to work out, along with improving the economic terms for the seller, we were able to agree on a lot of the legal terms ahead of time. And that saves a lot of legal time and legal effort. It can be deadly expensive if you start negotiating by draft. If you start negotiating terms by the lawyers going back and forth with their versions of the contract, that's going to ring up the meter. The most lawyers, notwithstanding, no joking around, the lawyers don't want to spend their time doing that. So if you can spend some time there, you can have the process go a lot more smoothly. The document process will take half or 2/3 less time than it would have if you get the letter of intent in the right shape.
Make a comment about that, John.
Yes.
When you do this, make sure that whether you're the buyer or the seller, it makes no difference who it is, that you understand what these lawyers are saying. Because they're speaking legalese, and I don't know what legalese is, and you probably don't either. So make sure you understand it. We had a valuation a number of years ago where the two lawyers agreed upon what the terms would be, and they did not ask any valuation expert about what they were doing with any of this. So now there was a dispute, and I'm looking at it and I'm reading what these guys, no offense, Tom, and just say, here's what the deal was. But they'd come up with their language to get this thing taken care of, and I'm reading it and saying, what in the world are you talking about? I don't know if you mean this or you mean that, because they agreed on the legalese, but they did not address the accounting or the valuation issues with that. Had to go get a legal opinion to have a different, we got an attorney CPA to translate what these two guys had done. And then and I did what, this third attorney had said. So make sure you understand what the attorneys are talking about, that you really understand. It's not just them themselves, but the client does too.
Right, and that letter of intent, that's going to be as close to a plain, language document as you're going to see, and that's the time to understand what you're really getting into.
Right.
And make somebody explain it to you. And then, just to your point, Richard, having team members who can help, so the lawyer's not misunderstanding what the tax consequences are going to be, or what the EBITDA calculation are going to be, or is critical.
Right.
Well, on behalf of Financial Poise, Catherine, Megan, Richard, and Tom, we thank you very much for your insights and sharing your comments and knowledge with our audience. And in addition, of course, we thank everyone who is listening live or on demand to our program. We really appreciate your kind attention and participation. As I mentioned at the outset, the materials contain the emails for all of us. And so if you have any follow-up questions, please feel free to reach out to us. Any one of us will be glad to hear from you. And we thank you for your attendance, and we look forward to seeing you again on another Financial Poise program. Take care, and this concludes today's webinar. Bye-bye.
Thank you, everybody. Y'all take care.
Thank you.